What time is it? Oh, it's 3 o'clock in the morning on July 4th, Monday. And I can summarize very quickly all of my kind of research into financial markets and market structure with price behavior. Basically, I'm interested in RSI divergence, uh, basically a change in momentum of price. So as price is dropping, the RSI indicator could be going in the opposite direction. So the two are diverging, which usually precedes a reversal. And if that signal appears on a trend line or a horizontal level, such as a pivot point, a support and resistance, or a key Fibonacci level, then it's very logical, because where you expect to find a reversal, you have the leading indicator RSI giving evidence that you're going to see a reversal. So it's very intuitive that you find those two signals together. And basically, there's 4 places you'll find an RSI divergence: in the middle of nowhere, which is irrelevant, on a horizontal level, on a trend level, or on the combination of a trend line with a horizontal level, be it a pivot level or a support and resistance level. So if you have price selling off very aggressively and then find you're on a trend line which happens to meet a horizontal level, and you have bullish RSI divergence more than 5%, you've got a good point to buy into the weakness expecting a bounce. But then you also got to consider that my back testing shows that the RSI divergence has got to be more than 5% to be relevant. Sometimes there is false signals that you got to avoid. For example, if you're coming down to a pivot and you have the first bullish RSI divergence signal between the inverted peaks inside the RSI indicator, you have to avoid that false signal, which, well, you don't know it's a false signal, but you have to avoid that signal until you get to the pivot, because more than likely that is a false signal. Because if there's going to be a reversal, more than likely the reversal will happen on the pivot level if there's a lot of weight and heaviness in that sell-off. So then there's also the idea that there's the reversal has different degrees of momentum. There's no momentum to a price reversal, where the price will change direction and you will not see an RSI divergence signal on the 1 minute or the 5 minute chart. Then there's low momentum, where you'll have an RSI divergence in the 1 minute chart but not the 5 minute chart. Then there's high momentum, where you'll see RSI divergence in the 1 minute and the 5 minute chart. And then there's something that I call fractal divergence. That's where you'll see an RSI divergence in 3 time frames, such as the 1 hour, the 5 minute, and the 1 minute charts. And that would most likely occur at the test of a key daily trend line. But it has to be at least a third contact of a trend line, because the second contact doesn't mean nothing. The third contact then has an expectation of a reversal, and the RSI divergence confirms that expectation. Then there's another idea I came up with about the types of market reversals that we'll see. I graded them from 1 to 4, from less abrupt to aggressive. So the less abrupt reversal is the type 1, where you have a consolidation period with an RSI divergence. Then the second one is a double top or double bottom with an RSI divergence. The type 3 is an RSI divergence at the end of an organized intraday channel. And then the fourth type is just a blatant RSI divergence that's not inside a channel, meaning the change of price is so steep and quick that the angulation away from the moving averages is so steep that you can't kind of confine the price behavior inside a nice organized channel. So that kind of sums it up really. There's the momentum of the reversal, there's where you expect to find the reversal, and there's the types of market reversals that you can kind of classify. And today I did like 12 hours of research and looked at this fractal divergence signal at the test of a daily trend line, and I found that out of 12 tests, in 8 of them there was fractal divergence, which was a strong indication that the trend line was going to hold as support or resistance. So it could be a very effective strategy for long-term position trading. That's it really.